From Wall Street to managing hundreds of millions in client money, Nick and I use our alphabet soup of credentials to discuss the investing and tax strategies that actually work. Oh, and we played Division I college football together, so strap in. This one hits hard. Let's go.
Alrighty, folks, it's been a minute since we caught up with the CEO of Life Goal Investments, and that's unfortunately my problem. I was out on some trips, but now we've got him back, a 10-year plus veteran of Wall Street. Somebody who talks to the top 1% of the 1% on the daily. We're going to catch up on earnings. Yes, the big banks start rolling out earnings tomorrow. We will talk about those and then the other parts of earnings. We're, of course, going to hit inflation. We've got a big CPI print tomorrow. And if you've watched my daily news, you know that I disagree with the experts. We will, of course, unfortunately, need to talk about Iran and oil. We will then roll into what the Fed does with this, talk about some retail investors. And yes, as a housing channel, we will close with housing. Taylor, how you doing, buddy? What's going on?
I'm doing amazing. I'm glad you're back from your gallivanting, and now we can get back to business again. Here we go. We got a busy packed agenda here, so I'll let you kick things off.
Yeah, people love it when we get together. We obviously have the same motivation to help people. We both are not afraid to make calls and own them when we make mistakes, which is a lot of fun for the audience. But let's talk about earnings. Obviously, Q3 is kicked off, which means we're going to get a wave of Q2 earnings. The big banks typically lead us off, starting tomorrow. So if we just look at the big banks, and this is Citi, Goldman, JP Morgan, Wells Fargo, and the like, what do you see there? And then we'll go to the secondary markets after that.
Yeah, it should be a very good quarter for banks, and especially banks that are a little bit more investment banking oriented. So SpaceX in its own right can make a mountain of difference on a bank's balance sheet when they bring that to market, and Goldman, Morgan were involved in that, et cetera. But also a shocking stat is that M&A activity for the first 6 months of this year versus the first 6 months of last year is up 50%, 50.
Wow.
Yeah. So that's
no
a
idea.
huge win at the back of these underlying investment banking oriented banks. So expect the ones that have the real investment arm to look really good. I heard an analyst on this morning talking about 40 to 50% earnings growth for Goldman and Morgan, which is just
absurd.
mind-numbing, right?
Yeah.
And then you also have commercial lending picking up. And the commercial lending, a lot of that comes in that high-profile area of AI. As you now see folks going to market and taking on debt, even the big companies taking on
20,
debt,
40, $50 billion. Nuts.
Crazy.
Yeah.
Nuts. And these banks are taking a vig along the way to set up these bond structures and then going out and shopping them to market. So from an investment standpoint, it should be a banner quarter for Q2 for these big investment oriented banks. The net interest margins actually compressed a little bit with the yield curve flattening some. So that's a little bit of a headwind where they want that bigger disparity between where front end and back end rates are. So you're not getting the tailwind there, but I think it's overwhelmed by all the activity that's playing out in the capital markets.
Yeah. No, I told the audience this morning that I thought the big banks were just going to frankly have blowout quarters for all that you stated and above. There is one area that I'm going to be looking forward to the big banks just watching this game for 20 plus years, because again, I think it's going to be one of those quarters that they're going to have room to do the following. And that is to put some reserves away.
Yep.
Right.
I knew you were going there.
Yeah. Let's bag a few reserves. Obviously, we've heard about a lot of private credit, lots of gates, things of that nature. There's obviously concerns still in the commercial real estate market. So I'm going to be interested in which of the banks strategically go, you know what, we're going to take 2 or 3%. We're going to tuck it away for a rainy day. Because I think that's a good move. You don't want to come out and report just crazy numbers to raise expectations going forward and then make the year-on-year compare next year terrible.
Yeah.
So I'm going to guess at least half of them kind of put some reserves away. What do you think?
Yeah, I think that you're probably not wrong. To your point, when you've got hay, ample, a bumper crop, put some in the barn. I don't think that's a silly thought whatsoever. On the other end, capital markets are still, you look at credit spreads are still razor thin. And although there's been a lot of noise around the private debt markets, you haven't seen any material degradation in underlying capital in the private or the public debt markets. So I don't necessarily know that there's any, canary in the coal mine warning that, hey, if we don't do this, you're going to be in bad shape. But I think that your point is really well put. When you have just an absolute banner quarter, which they should anticipate having, I think you're going to hear that over the coming days. Then putting some away is just
it's just a smart move.
Yep.
Yeah.
Yep.
These guys are these people are not dumb. So let's go to the kind of second tier. Again, I told my audience I think the big banks are just going to be monsters, as they usually are. But I'm actually worried about the next tier. So the ones that were not participating in SpaceX, the ones that maybe are more impacted by bad debt in the commercial markets, the ones that are more impacted by the flattening of the yield curve. What do you see there? Because I'm not convinced that tier is going to be obviously as good, and I'm afraid there might be some surprises there.
Yeah, I think you are going to get a bifurcation, and most of that is only because the big banks do that well. It's only because the capital markets have been so euphoric or frothy, right? And we came from a depressed M&A cycle over the past couple of years, and so we're just getting back towards normalcy. It's not that we're in some euphoric, absolute boom state. It's just more normalcy now. And so I think you get that takeoff with the big banks. And to your point, I think that the regionals, the more geographically centric smaller banks, they just don't get that massive tailwind. I don't think that they start to see huge markdowns on their underlying debt, because I just don't think that the consumer or corporate America is in bad shape. I think everyone's pretty well handling this economy. And so I don't think that there's any nasty downside. I just think that there's a bifurcation in the market. And by the way, you have seen massive moves from Goldman Sachs, from Morgan Stanley already. So the market sees this one coming.
Yeah.
It's not going to be surprised.
Yeah. It was put on the tee. It's not like it was a surprise. Yeah.
Totally. The market always moves first. So
no, I love that. Well, let's talk about one more thing on earnings and we'll get to topic number 2, inflation. And that is, I'm hearing more and more people confidently say with like their full chest that earnings in the S&P 500 next year will be 400. And of course, if you slap a 20 multiple on that, more and more people are talking 8,000.
Yeah.
That's a lot of earnings growth. What say you?
It is. And it looks like through the remaining 3 quarters of this year, including Q2, which we're about to get the report on. Yeah. So we're about to get the report Q2 and then Q3, Q4.
Got it.
It's roughly 25% growth this year. Wow. There is just, it's hard to look at these hyperscalers and have them look you dead in the eyes and say that we continue to have more demand than we're able to supply. Yeah. And not think that the build out is going to come to fruition. The timing of it coming to fruition, I think is a bit of a question, where you're starting to see some delays in these underlying AI build outs and the schedules of them. And you also kind of have this, it's correct accounting, but it's tricky accounting where, okay, NVIDIA sells a chip to XYZ and they report the earnings right away, but the accounting of the expense on the other end is something that looks very different. So they're getting all the bump on the front end, but the expense, the negative, the income profile to the buyer is depreciated over time. So it's this mismatch in earnings, and it is inflating earnings. Albeit
no question. Yeah.
Albeit it's all according to GAAP standards. They're doing things correctly, but just the mechanism of how the accounting world is set up, the income is being booked immediately. The expense is being booked over time.
Yeah. Again, this is something that a lot of folks have been pointing at. I guess, what is it? Michael Burry's been one of the, Burry's been kind of calling this the accounting shenanigan. Again, it's completely GAAP financing, but, when you understand the numbers involved, it does look a little squirrely.
Well, they're also, the magnitude of the numbers is just absolutely astounding.
Unheard of.
I think $2 trillion is the expected spend on AI worldwide in the next year or something.
Absurd.
You can't even fathom the numbers. Like, you just become numb to them.
Yeah. All right. Well, let's move on to inflation. We got a monster inflation print tomorrow. Last month was 4.2. The experts are calling for 3.8. This is obviously headline numbers. If you want to talk core, they're talking it was 2.9 going to 2.8, so not quite the move there. I'm actually out on a limb. It's a pretty shaky branch. I think the experts are going to be wrong, and I think it's going to come in higher than expected. I think it'll be 3.9 or thereabouts. But I'm curious what you see out there. You're obviously much more involved in Wall Street and got a lot more PhDs around you. So tell me I'm wrong. Why am I wrong thinking it's coming in high?
I don't know that you're wrong. It's funny, with the spend that's going on this AI build out, what it is front end loading inflation, back end loading disinflation.
Correct.
So effectively, what I mean by that is like the spend that's taking place right now is causing a lot of hiring in the underlying construction space and a lot of spend. And with that spend, especially with the bottlenecks on the supply side, what you're seeing is these kind of chip manufacturers, et cetera, just inflating prices and moving them higher and higher and higher because there's so much demand for the underlying product. So that's driving inflation at the bottom line on the supply side of things because the demand is so darn strong. Now, it should, and this is Kevin Warsh's big argument, it should lead to a productivity balloon, if you will, on the back end. And so when productivity improves, you should see inflationary pressures curb and actually go negative. And I don't mean outright negative inflation. I just mean disinflation, a slowing of the rate of inflation. But it's something that we need to digest. And I think that the market is uncertain as to how long it's going to take us to digest that. And I think that the experts don't know how long it's going to take us to digest that. And that'll be the big outstanding question mark. And I don't see you as being hugely wrong on saying that it comes in higher. I think higher is more likely than lower. You haven't had the reprieve. You haven't had the reprieve in any of that underlying bottleneck, which is the necessity in order to break some of this inflation in the number one spend sector there is, which is the AI build out.
Yeah, I love all of that. I see that and a little bit more. The reason I'm going 3.9. And again, this video is going to post today at 4 p.m. Pacific on my channel. So again, we'll put this out so the call is known by everyone. I just think inflation is going to be more diffuse. Again, I think a lot of people are looking at the collapse in oil over the reporting period, and they're kind of over rotating to that collapse. It has been massive. It has been welcomed. But oil is in everything, and it doesn't change the other, attributes that quickly. And back to your point about AI, it's again causing real inflation. I mean, just think about what Apple was forced to do in the iPad and the MacBook Pro or whatever the hell it is.
Yep.
This stuff is real, and not to mention data centers in energy and electricity. So again, I see a lot more reason for it to be higher than lower. So I'm calling 3.9 or higher. A buddy of mine's 3.8 or lower. But yeah, it'll be interesting to see what that comes in tomorrow.
Yeah, it's interesting to think about that oil, just kind of the secondary function of that. Yes,
Correct.
Oil prices are back down meaningfully in the 70s, but a year ago they were higher than they are today, to be clear, and
Correct.
gas prices were nearly $1 lower. So it just takes time. There's those
Exactly.
gas tanks don't fill and unfill underneath that gas pump at the local mobile station very quickly. So they fill them up at high prices. And by the way, they're not taking the price of oil risk at the gas station level. They're not.
No.
They're going to pass it right along. So unfortunately, what is the old statement? It's, oil or gas prices rise like an elevator and fall like a feather, or something,
Exactly.
something like
Something
that,
like
where
that. Yeah.
they're not going to take the risk. So they're going to end up making more money rather. And because, oil is relatively inelastic. Gas is
Correct.
relatively inelastic. We're going to, unless things get crazy, we're going to continue to do the normal travel that we do, et cetera. Stuff is going to continue to get shipped to your house. All of those things until it gets nasty, and it's just not nasty. That's the reality of it.
Yeah.
$4 a gallon, which I think is the national average at this juncture,
Yeah,
isn't scaring drivers.
No. Well, unfortunately, that leads us to the next topic, which again, I look forward to today. You and I never talk about this again, and that's this Iran war, conflict, struggle, whatever the hell you want to call it. Again, it seems to be repeating a process. Everything is good during the week, and then bombs fly on the weekend. It's very tiring and manipulating and just crap. But again, it seems to be getting worse, right? There was hope that this peace, thing would stick. I have long believed, and frankly, long said, so I have receipts, that I think Iran is willing to suffer a lot longer than we are, and that's a problem. And this ain't over yet, is kind of my feeling.
The problem is there's just lack of clarity as to what Iran is looking to get out of this, I think is the reality of it. So there were ships that were hugging too close to the Oman side of the Strait of Hormuz, and that pissed off Iran. And so they fired missiles at them. And it's like, what is going on?
What are we supposed to do? Yeah.
How do we get this right? Because we are trying to, now this is such an overstatement, I'll get beaten up for this. We are trying to, as gracefully as we can, get out of there. right?
Right.
And it's not graceful. I totally get it. That's a poor choice of words, but that's what we're trying to do.
We're trying to escape. I mean,
We're trying to escape, but the caged animal that is Iran right now is pissed. And so they're continuously coming back at us. And now we've backed ourselves into this corner. I talked about the fact that we got painted into a corner, and this corner we've been involved in for a long time. It's like the World Cop corner. And it's as soon as you go somewhere and you slap someone on the wrist, right, wrong, or indifferent for what they were doing in the past, and now when they act up, you're there, and you're the one that has sworn to now allow smooth passage through the Strait of Hormuz, right? There's a lot of underlying country ships going through there, but we're the ones there policing it now, and we're stuck there because when they act up, we have to punish or whatever. And I know that sounds like so, red-blooded American, like we're right, they're wrong. I'm not necessarily saying all of that, but I'm saying that is the stance that we're in at this juncture, and we don't know, or at least I'm not clear. So either the government's doing a poor job of messaging what it is Iran is trying to get out of this. We're not clear on that.
Yeah, I couldn't agree more. Well, let's move off of that, because again, I unfortunately think this is going to be around us all freaking year. Which again, if you zoom out and think about this still going on in December, probably means oil is higher. But one more thing on oil that may be a surprise to you is I think we're 12 months away from an oil glut. Right. I think we're going to be in a tough spot for the next 6 months or so easily. Oil could certainly get back over 100 in my opinion. But I think 12 months from now, the Strait of Hormuz is going to be less relevant.
Yeah.
Right.
So I have an interesting take on this because, and I've already done a video that I haven't put out yet on it. And I think the controller of the oil market is a non-oil producer, which is kind of crazy. And that's China. So China is controlling global oil prices. When you take a step back and look at the broader environment. So
interesting. Tell me more.
China's got an SPR that's it's tough to see exactly what their strategic petroleum reserve levels are, but it looks like it's about 2x to 3x the size.
Yeah, I was thinking it was 2 to 3x.
Yeah, and so it's basically state run, whereas the U.S. it's not all state run. There's underlying players that make decisions there, et cetera. But China is very, very active in the use of their strategic petroleum reserves. They're a long-term player. And when oil was low in 2025, they were buying hand over fist, just filling up their reservoirs. And then when oil got to 100 and broke through 100, China said, we're not going to buy an ounce.
We're out.
Or a barrel, I guess I should say, of oil. So they're just this buyer that's in that 100 to 65 ballpark. They will buy from 65 to 100. They will not buy anything above 100. And because they're a state-run economy, they have a lot more ability to dictate how much oil usage is actually taking place in China and how much, filling or utilizing their strategic petroleum reserve that actually has taken place. So I think that China is actually going to be a moderator of oil price volatility in perpetuity now.
Oh, I love that. I'm going to dig into that some more. It's a great insight, something I had not thought about. So thank you for giving me something else to research. I appreciate it. That's fun for me. Well, let's move on to the Fed. Obviously, it is very clearly we got a new sheriff in town. Kevin Warsh has been a man of his word, right? Saying less, not giving forecasts. The Fed minutes is a great example. The Fed minutes, the last one under Powell was 7,400 words. This one, I think, was 5,900 or 5,800 words. So I think they're going to get smaller and smaller going forward. He's already nominated the task force, which is something I was waiting for, right? He's got a bunch of 5 task force going out there. So let's just talk about Kevin Warsh's, call it first 6-8 weeks in the job. What say you?
Yeah, I think that he avoided what could have inflated a market in a massive way. And we discussed this 3 weeks ago or whatever it was the last time we chatted. We said, listen, if Kevin comes out and says we're going to stare through inflation and that this thing is strictly transitory and I'm going to continue to be a lower interest rate for longer person, et cetera, that would have ballooned the market. He didn't do that.
No,
he's come out as a hawk, right? And so it's interesting to see just, Trump just absolutely smoked Powell every time he took a more hawkish demeanor. And then he puts in Warsh, and Warsh takes the hawkish line, the higher interest rates for longer line. And you haven't heard anything out of Trump, which has been interesting. But you also have to give credit to Kevin for sticking to what his guns are of saying that inflation is more structural, at least for the time being. He has been clear that he thinks that AI will end up producing higher productivity and bringing down inflation, but he's saying we're not there yet.
Yeah. The one thing I will say is the Fed meeting minutes were the hawkish minutes we've seen since 2022. Now, the question I have, knowing the game that is sometimes played by experts like Kevin Warsh, and let's be clear, he is a game, he's a grandmaster, right?
Yeah.
He's worth 9 figures, folks. So
Yeah.
again, he knows what he's doing in these markets. Part of me wonders if he came into this knowing he's going to act like a hawk for a while because the market will give him time. He's obviously had one meeting already. He's got a meeting at the end of this month, and then he's got Jackson Hole.
Yep.
To me, that's the coming out party, his first Jackson Hole meeting in August. And, the question I really ask myself is, will he have enough time to do a readout of these task forces by August? I just don't know. What do you think?
Yeah. It's interesting that Jackson Hole winds up being such a pivotal place when it's not a period of time where you're actually going to make an interest rate decision.
Yeah. Yeah.
But it's proven to be incredibly pivotal in the past. Powell 2 years ago made an incredibly important speech there and turned markets on a dime.
Upside down.
Yeah. So it's really where they set the market up for what's to come in the future. And I think that as of right now, if you were to ask, hey, Kevin, what are you going to say out in August? Like, I don't think
he knows. Yeah, I don't think he knows. Yeah,
he doesn't. So they're taking in data, and they're trying to digest it. And I think that this CPI data that's coming out here tomorrow, like I don't know that anybody has a perfectly clear view as to what that's actually going to portray. Because again, on the one side, you have oil's reprieve. Although the price, yes, the headline price of oil has come down, but all the underlying components that it goes into haven't. And then you still have this continued AI build out. You still have these either memory stocks or chip stocks, et cetera, continuing to bloat the balance sheet and bloat the prices. So you still got that underlying pressure. So it's interesting. I don't think there's a clear read through on any of it at this point.
No, I agree with that. So what do you think? So again, I think it's really interesting. So these task forces that Warsh set up, I think if you and I were guessing men, we probably would have gotten most of them right. Because again, I think we all knew what Kevin Warsh's game plan was going to be, right? Better data, less forward guidance, all of those things that are part of the task force. The big question I still have is, and I want you to address is, do you think he gives a partial readout of what those 5 task force have done?
Yeah. Did you notice I avoided that? Like
I did. And I'm going to put the ball back on the tee and make you swing.
I think you start to get some clarity. Right? Yeah. I think that, what he's put in is some of the, Mark Andreessen, like just an incredible investor, an incredible data gatherer. He is in the VC space. So his ability to look at things from a different angle and collect data in a rapid fire way, he's not doing it, but whomever is involved in the back end of his team is doing that. You got to imagine within a 2-month period of time, they can start to put some statistics in front of us that are better outputs than what the government's been putting out in front of us for a decade now. Yeah. And so
I've actually met Andreessen well over.
Oh, really?
Ago. Yeah. Well, maybe 15 years ago.
What was the interaction? Or what?
He was running a company. I think it was called Opsware, or he was a part of Opsware, a company I bought Opsware. And I met with them several different times. And the funny thing about Mark is people think he talks fast today. He talked twice as fast. I mean, his mind just works faster than anybody I've ever seen.
Well, what does that tell you about August then?
Yeah, I think
at least from his perspective of what he's able to bring to the table.
Oh, he probably has the answer already.
Right.
So
he's like, let me speak. Let me get this in front of you now. And he probably knew this was coming for 6 months too. So he's been prepping.
No, I agree. So I think August is going to be important because I think that's where Kevin Warsh is going to plant his flag. He's basically, without saying, he's going to say the Fed of tomorrow is not the Fed of the past. We're on a new path. We are the new Fed. Better data, faster data, So that's what I expect to happen. It may not be the final readout, but we're going to get something.
I don't know if I mentioned this because it was true probably the last time we spoke as well, but as of today, CME forecasts for Fed funds rate, there is a higher likelihood that we have 4 rate hikes in the next year from today than we have 1 cut.
Shut up.
4 rate hikes.
4 rate hikes is more likely than a single cut.
Correct. Yep. That's the market's price.
Which person on this channel told you 6 months ago a rate hike was coming? I just want to know.
So I think for the record, I think we don't get one this year. And I know you also stand in the camp that you don't think one is needed, but you think we will get one.
I think it'll end up being a mistake.
Which is not the same thing. I understand that.
Yeah.
I don't think we get one just because.
I don't think we get 2. Let's take that off. Right. So I think we get 1. It's a mistake. Anyways, yeah.
And then they revert course. Like you said, they're going to chase their tail. And exactly. That's not incredibly unlikely. I just don't, I think that Kevin Warsh is a bright guy. And by the way, I don't think Jerome Powell is a dummy by any stretch. No, but I think Kevin Warsh is a bright guy, and he looks at this and says, listen, at the AI level, I get that it's demand driven. Mm-hmm. But outside of that, it's not the regular consumer that is incredibly interest rate sensitive that needs to be batted down. And that's what interest rates do.
Yeah. It's funny. We haven't talked about this, and my opinion changed on my trip because I never stopped reading. I just stopped talking to the camera. I'm actually I won't change my opinion because I don't want to do that. I like holding myself accountable. But if you put a gun to my head, I think the chances of nothing all year is now higher than a rate hike. I still think a rate hike is more likely than a cut, but I think do nothing is probably the lead horse right now. Yep. That did change in the last 10 days or so.
Listen, we also have to stop thinking that the Fed needs to do something every single time they meet, right? So it's like, listen, status quo is all right. Yeah. Like there are a lot
do nothing is okay.
Yeah. There's so many variables at hand right now that there isn't a ton of clarity on that. Just let this thing sit for a minute and then react. And I don't, that's the stance that I'm in.
Well, let's go to the retail investors, because I think there's something quietly happening underneath the surface. You have the data to kind of see the flows. I'm going to say out loud, and you tell me if I'm wrong or right. The retail investor is tapped out. The amount of investing retail investors are doing are approaching record lows. They've been hurt a lot by the ups and downs, right? Kind of the buy the dip thing. So I think retail investors are out of dry powder. Am I crazy for thinking that?
No, I think we've hit this point of digestion in the market right now. So, everyone was piled into the Magnificent Seven names. Magnificent Seven names have now started to trail some. Yeah. People went from, them being just incredibly cash flow generative and not spending and therefore just heaping piles of profit to now them going cash flow neutral or cash flow negative. To build out further and further. And now the consumer is starting to, the investor rather, is starting to question, okay, when do we see the profits bleed through? And so now they've shifted their focus from buying the Magnificent Seven to buying the underlying components and memory and things like that. And so, but now you're starting to get a reprieve on that trade. And it's funny that it's happening. Micron sold off after posting one of, the greatest quarters of all time. Yeah. And so but that's not abnormal. That's not abnormal. Markets top on good news. They don't top on bad news, which is kind of weird to say, but the market's just looking through and saying, hey, are they able to increase the price of this underlying component at 100% in perpetuity? Probably not. And so therefore all of a sudden profit margins start to be squeezed. And you've got some new players entering the space. So like NVIDIA cannot get out of its own way. It can. It hasn't done anything in 8 months. Well, that's because all these hyperscalers are now building out their own chip components.
Yeah. And oh, by the way, NVIDIA is releasing an LLM. So this is about to get really noisy.
Yeah. You start to have business models start to shift where NVIDIA wants to own the whole stack now. Yeah. Whereas before they were only building the most profitable component of it. Now they're going to spend on the stack on the other end. And now you have Google on the other end starting to build a chip and start to market it more broadly than just use of Gemini. And, profit margins for NVIDIA have been mid-70s, which is just absolutely bananas. At some point, someone needed to create a product to come in and disrupt that.
Your margin is my opportunity.
One of the greatest lines ever by Jeff Bezos. And look what he did with that.
Yeah, amen to that. Well, I didn't tell you this was coming, and if you want to punt or pass on it till next week, you absolutely can. But since we're talking about retail investors, we had a huge announcement on July 4th. Trump accounts went live. Don't know if you had a chance to look at them. I didn't ask pre-show, but any thoughts on Trump accounts?
It's silly not to open one if you have a kid that's born in the time frame that
Yeah.
that is the free $1,000.
Yeah, free money's not bad. Is that what we're saying?
Yeah, it's incredible, right? And so there are some wonky nature to it. I believe they can only be opened on Robinhood is what I believe to be the case, which I thought was very odd.
Well,
Et cetera.
Robinhood did design the GUI or the user interface, so that could be
Okay,
right.
so there you go.
Quid pro pro, yeah, maybe.
And don't hold me to that, but I believe that to be the case, that it is just Robinhood where they can be opened. But no, it's a strong thing, right? If you have a kid born in that age and you don't open a Trump account, you're being negligent. And it's funny how more and more of these things are rolling out. So Micron has now and I'm going to butcher this a little bit, but for the folks in central New York that have children, they've now offered, I believe, $1,000 to the folks in central New York that have children during a certain window.
So I think Trump accounts, when we zoom out a decade, are going to be proven to be one of the largest philanthropy platforms, or I don't know, entities, or I don't know what the right word to call it.
Yeah.
Because not only we're going to see businesses do this, we're going to see businesses donate stock is the thing that I think is coming next. Because again, I think we're going to, and I think Trump accounts in a decade. I mean, think about kids born today in 26, when they're 10, 12, and 36 and 38. They're going to have their phones or whatever the user interface is then, watches, whatever, and they're going to be looking at their accounts. They're going to be owners in this system.
Yeah.
I think Trump accounts will be the thing that single-handedly kills socialism, or makes sure socialism is dead in 12 to 15 years, because they'll be owners of stuff.
Anytime you can get people invested in the market, especially before they even know whether they want to be or not want to be.
Before it's a choice. Hey, congratulations, you're born. Here's $1,000.
Compound interest is the eighth wonder of the world, and there's no better compounding mechanism than the stock market at the end of the day. Yeah. And so anytime you can effectively force, or again, make someone negligent if they don't take advantage of it, basically forcing them to do so, it's crazy to think that. And you're right. I mean, the Dell family, right, has contributed. I can't remember what the number is. 200
billions.
Whatever.
Billion,
yeah, just an ungodly amount of money. So
did you actually ever do the math? Did you do the math on $1,000? Do nothing else with it and then look at it at 65? Did you ever do that math?
Well, I can do it for you in 2 seconds. 65 years on $1,000.
It's say 8%.
Present value, 8% return. Future.
It's got to be like 200 grand or something.
148.
148 grand. And again, if you take it from 8 to 10, it jumps even.
Oh, that makes it. Let's say 490. You see how little changes. You see how little changes make a massive difference when it comes to compound interest.
Yeah, you take an extra 2 points over 65 years. Yeah, it damn near triples. Yeah. All right, well, let's close on our final topic, the one that probably is most interesting to this channel, and that is housing. Housing has been in a depression, right? At least on a transaction basis. On the other side, just reported by NAR, existing home sales median home price set another record. Home prices have been up 36 months in a row, even though the crash bros and crash sisters keep talking about a 38% housing crash, which is complete nonsense. But what say you?
Yeah, I'm interested to hear from you as opposed to me on this, because this is your wheelhouse. And I'm also interested to hear how you think that the new law that Trump did not sign the bill of, I want to hear what your thoughts are on the pros and or cons of that underlying bill, because I think the biggest change that makes is the institutional buyer has to step away from single family home purchases. Mm-hmm. But I'd like to hear if that's also the case for you. It's funny, we talk about real estate and we talk about the fact that, the housing market's frozen, et cetera. And even in my area in the Northeast, housing prices are really strong in the Northeast.
Yeah. Yeah, they are. Might be the strongest in the country, frankly.
Yeah, but there aren't many houses, right? One goes on the market, it gets bought very, very quickly. And at a number that you scratch your head and you're like, holy, that's a lot more than I thought that number would be. Yeah. But yeah, pending home sales, they're expecting to come in modestly negative month over month.
Yeah.
So it's just this 6.5% rate is just something that folks are having a really hard time justifying the monthly payments at that arduous rate.
Well, I think there's a lot of things going on in the housing market that most people miss. So I'll give you a couple of them. First, we have to realize that you and I are talking about it most often is reported as the median home price, right? Median being middle.
Yep.
And what people don't realize is I've tried to call out for the last 4 years. There's been a structural imbalance in the quote unquote normal housing market. We've essentially frozen the bottom third, right? If you got into an entry level housing with a 2% mortgage rate, you're not moving, not because you don't want to, but because you fundamentally can't afford it.
Correct.
So we have taken the bottom half and we've basically said, and this is where people can argue, is it 30%? Is it 35%? Whatever percent, a meaningful percentage of that portion is not transacting as they normally would.
Mm-hmm.
And then we have the K-shaped economy where if you are a stock investor and IPOs and all of this, you're feeling better than you ever have.
Correct.
So you're transacting more.
Mm-hmm.
So we've taken this median number, and just because of how the math formula works, it's been moving, but it's because of the distribution of what's transacting. I think most people are missing that.
Let me puke that back to you and what I think I'm understanding out of that. So basically you're saying that the median home price has been meaningfully drawn higher because the amount of transactions that are happening in the top of the market are so much more frequent than what's happening in the bottom of the market that's just frozen.
I'll give you a precise example, which you could Google. I think I read this over the weekend. The numbers will be close. Transactions over 600 grand, which again, the median is 440. So 600 grand is meaningfully above that.
Yep.
Are up 12% year on year. So again, if you realize that part of the market is up 12% on a transaction basis,
right,
and the lower end is not, guess what happens to the median, folks? It goes higher.
Yeah. And the other kind of statistics, and you might know these better than I, but the amount of homes being purchased in cash, is if it's not at a record, it's darn near a record
close.
Yeah,
it's darn close. Yeah. So again, I think the other thing, and it's funny, I went on an 8-minute rant this morning on my daily financial news about the housing market because again, we have a record median home price, which again, I've already given you one of the reasons. But people don't understand that most people don't buy housing for cash because there's a housing doomer out there that loves to talk about home prices and incomes. And we've never been so stretched. That is both factually correct, but also completely meaningless because most of us buy with debt. So you have to calculate the cost of capital. People today love to say that home prices to income have never been higher. And then they say it's never been more or less affordable. And that's just not factually correct. 1981 is still the most unaffordable housing market, whether you like it or not.
Because and what I will tell you, we're at 17%.
18. Yeah, 18. 17, 8. Yeah, whatever it is. And by the way, if you really want to geek out at this, 2023 housing was less affordable than 2026. And it just blows people's mind.
Because interest rates were higher?
Interest rates were higher, but also, and this is the last thing, and this is what I told people 5 years ago would take 8 to 10 years. So we're 5 years into this. We need wages to grow faster than the average median home price. Mm-hmm. And for 36 months, 50 months, 50 months, wages have been growing faster than home prices. That's how this heals. It's slow. It's painful. Nobody loves it because we all want to crash. But you know what? You get another 50 months of wages growing faster than home prices. We're right back on trend.
Yeah. And so circling back to one of the questions that I had was, what do you think about this underlying regulatory change or whatever that just got signed into, I think or didn't sign, but just came out?
It becomes law 10 days after if the president doesn't do anything, something like that. So it's either law now or will be law tomorrow or whatever. I think it's a bunch of nothing. I think there
nothing now, or because a couple of the analysis that I read said nothing now, but can change and be productive over 3, 4, 5 years.
So I think there's two things that I've read in it. And again, if you know something that I say is factually incorrect, please correct me. One is they're trying to solve yesterday's problem. So what are they trying to do with this? The big boys can't play in housing. Well, whether we like it or not, the big boys saved the market in the GFC. They were buying thousands, if not tens of thousands, a home with a check without even inspecting things, because we needed a buyer and they stepped in. Mm-hmm. That is essentially what they've eliminated going forward, right? They've capped them at, I don't know what it was, 1,000 or 500 or so. So basically, hey, you can't buy existing homes anymore. They're not required to sell. They just can't buy anymore. But what people don't realize is that business model is dead. The big players have not been in the market because they realized buying older homes, sight unseen, in different areas without a buy box is a recipe to lose money.
Yep.
So they're not doing that anymore. So they're kind of regulating yesterday's problem.
And it's interesting. So a knock on there, if I cut you off there. So a knock on there is, in the event that we do have a nasty environment at some point in the future,
they'll have to change this.
Yes. They're going to have to revert this. So there is a buyer in place when values get low enough to make it make sense.
Yeah, correct. And again, this happened once in 100 years. Could it happen again? Sure. But the fact that we may have, a 40% drawdown over 5 years is pretty unlikely.
Yep. Agreed.
But the other thing that's in the legislation, and this changed with a lot of going around, but I think they got it right. They basically green-lighted or approved build for rent as a business model. And that is huge. Because again, what I'm trying to tell you is this whole existing model that they solved for, that's not where they're playing. They want to go buy 100, 500, 600 brand new things and rent those out because it's very much apartment-like. Yeah. It's just not vertical. It's, it's larger.
And you can buy at scale with confidence.
Yeah. Yeah. And you can use your balance sheet to get better debt. And so basically the legislation will make people feel better, but it will do absolutely nothing. And it's greenlit probably the biggest opportunity for Wall Street, which is build for rent. So Wall Street's like, hey, awesome. You can call me the bad guy. I'll stand up for the picture. But you and I both know I don't buy that shit anyway. I'm over here already.
Does it speed up build out?
Absolutely. It basically... There was a threat with one of the early iterations. I think there was a 7-year clock, and that's not enough time for return on capital, or it would have been close. They would have been forced sellers, and we both know that markets have cycles, and you don't want to be a forced seller in a bad part.
Yep.
But as soon as that got yanked, I would expect dollar invested in build for rent to be up certainly 50% and possibly 100% in the next 12 months.
Why did Trump not sign this? He caught a lot of flack for not signing it and being this is being billed out as, hey, this is going to be a huge win for the underlying housing market. You just told us that it really is not going to be a monumental shift. But what was the downside to Trump and why he wouldn't sign it?
I think again, I can only guess. Who knows?
I have a guess too, but go ahead.
So my guess is Trump saw the bipartisanship of this, and he wanted to use it as a negotiation to get Save America.
Yeah.
So that's the trade-off that he was going for. I don't think it worked.
Yeah.
But that's again, Save America Act could be the thing he's most known for if it got done. And I think he was trying to take the most bipartisan thing and get them connected somehow.
Yep. Totally agree. That's where I thought you were going to go with that as well.
Yeah. Well, this has been fun, man. We covered financials and earnings, inflation, Iran, retail, the Fed, Trump accounts, housing. People need to check you out. You have this Instagram page, and I hear TikTok, but I never go there. But on Instagram, you do these 5-minute clips inside of 60 seconds. I have no idea how you do that. It's pretty cool. Where can they find you?
Yeah, we're at Life Goal Investments. We're on Instagram and TikTok, putting out daily stuff. So appreciate the heck out of your kind words. I appreciate coming on here every week with you. You're a source of information for me from an economic standpoint because you're better read than 99.99% of the folks out there.
I appreciate you, family. Take care. Have a good week.
Talk soon. Quick ask. If you're enjoying the show, hit the follow and drop a rating. It helps more folks find our podcast. Thanks so much.
Discussed in this video is for educational purposes only and should not be considered investment, tax, or financial advice. Investing involves risk, including possible loss of principal. Always consult a qualified financial professional before making any investment decisions. Past performance is not indicative of future results.